Hey guys, it's Alex here. Today I'm going to talk about contingencies and what they are and what the main ones are in a real estate transaction. Hey guys, Alex McIvor here with Dunnigan Realtors in Sacramento, California. Today I'm going to be diving into contingencies. So let's kick it off with the basic question. What is a contingency? Contingency are clauses of the contract that let a buyer, there's also seller ones, but I'm just going to focus on buyers for the majority of this because this is where it's most relevant. They are clauses that let the buyer opt out of the contract if certain conditions are not met without risking their security deposit. Basically, it's giving the buyer time to do their due diligence, to investigate, go through the loan process, and make sure that the home appraises. And there's a whole host of other ones. They need to be able to review documents that the seller provides about disclosures. If there's an HOA, they need to get time to be able to review those documents, make sure that they agree with everything in them, or at least are not totally put off by any one particular thing in there. But it's basically just giving them time to then do their investigations and make sure that the process is going to go through. Also, another caveat is that this is for California, and really you should check with your local real estate professional because these terms and some of the advice I'm going to give is all relevant to California, but it may be different if you are in a different state. So what are the different types of contingencies? Well, there are a ton of different contingencies, but the main three that you will negotiate in a purchase contract are going to be inspection, appraisal, and loan contingencies. So first one's first, the inspection contingency. This is, I think, the main one that people think about when they are thinking about contingencies. And worrying about getting into contract and making sure that the house is absolutely perfect for them. So the inspection contingency allows you to basically back out of the deal for not quite whatever reason, but pretty much whatever reason. And it could be as little as the home doesn't get enough sunlight, or I thought it was oriented a little bit differently and I realized it's not perfect for solar, or it could be something major that you're doing your inspections and there's a $50,000 repair that needs to be done to the foundation. That's kind of the big worry, but it could be very slight. It could be, I thought it was pink and actually the home is slightly peach. It could be that. It could be as little or as mundane as that. And that really gives you a wide breadth of range to back out of the contract as a buyer. That said, the seller knows that, so they are going to want as short of a contingency as possible, a inspection contingency. In particular, they would love to have no inspection contingency. I do not recommend doing that. It puts you as a buyer into a lot of risk, so that unless you are a flipper, or you're going to tear down the building anyway, or what you're doing already, I don't really recommend doing it. If you are a first-time home buyer, you certainly don't want to do it. So you just want to be careful there. So the next contingency is the appraisal contingency. Sometimes it gets confused with the inspection contingency just because they both involve sending out a person who's going to do some investigations, but they serve a pretty different function. So the appraisal contingency is just saying that the home is going to appraise at the agreed upon purchase price, and if it doesn't, you have the option to walk away from the deal as a buyer. So if you are in contract for $500,000 and it comes in and it appraises at even just $1,000 less, then you have the option to walk away from the deal and get all of your security deposit. So what to do in the event of a low appraisal? So you can either contest the appraisal, which you might have limited success unless there was a glaring error. They're going to be typically reticent to readjust what they had previously done. You can, as the buyer, come up with the difference. you can ask the seller to split the difference, or the seller can reduce the purchase price down to what it appraised at, or you can walk away from the deal. And being able to walk away from the deal is what the appraisal contingency allows you to do without risking your earnest money. You will still be out the money for the appraisal and for the inspections, but you won't be risking whatever you put into the earnest money. A note here is that cash offers do not need an appraisal because they are cash, they're not financed, so there's no bank that needs to get an assessment of the value. So that's one reason that cash offers are more they're more of a sure thing, and sellers tend to like them because you don't have to go through this process. There's a lot to talk about with appraisals, so I think I'll talk about them in a separate video as well. The last contingency I'm going to talk about is the loan contingency. This is just stating that you are going to be able to get the financing that you stated you were going to get in the purchase contract. So if for whatever reason, your credit took a hit, or the rates went up, or just for whatever reason you went through the process and your loan application was denied, this allows you to back out of the deal and retain your security deposit. So what are the time frames for these contingencies? Well, a typical escrow, I would say kind of the standard is 30 days. The standard, as it's written in the CAR standard RPA, Residential Purchase Agreement, is 17 days for inspection, 17 days for appraisal, and 21 days for loan. That said, in this market where it's pretty competitive for buyers, a 17-day inspection contingency I don't think is all that aggressive. I typically like to reduce down to 12 days. So that way you are reducing that and it looks better for sellers. It looks more attractive to sellers. But you're not going to be as squeezed for time as if they came back and said, hey, can you do 10 days instead, which they often will if you don't touch that 17 days. For the other two, for appraisal and for loan, definitely talk to your lender, see what they're able to do, because that's kind of out of your real estate agent's hands. If your lender is able to do contingencies, the appraisal and loan contingency faster, then by all means you can reduce that contingency in your offer, but speak to them first, because you don't want to get caught in a situation where you said, hey, we could get rid of the loan contingency in 17 days or 15 days, and then the lender says, what? No, we're backed up to our gills in loans and they can't make that work. And then you might have to release your loan contingency before you have approval from the lender, and that puts you in a scary spot. So don't recommend doing that. Definitely talk to your lender if you can reduce the lending and appraisal contingencies. So that's all I got for you today. If you have any questions or concerns, please drop them down below. I'll be happy to answer. As always, if you liked this video and found it helpful, please give me a like and subscribe. It's very helpful to me. Please feel free to reach out if you have any questions, particularly about real estate in Sacramento, but I'm always here to chat. Thanks so much. Bye.